Alright, let's dive right in and address the elephant in the room. Those conversations that make us squirm, that we tend to avoid at all costs. We all have them, those topics that bring about a sense of unease and discomfort. And one of the biggest, most sensitive of these conversations revolves around our home, the place we've built memories in, and what happens to it after we're gone. It's a topic loaded with emotion, practicality, and often a great deal of uncertainty. We often avoid these talks, hoping that the problem, the questions, the potential difficulties will somehow magically disappear. We tell ourselves that we'll deal with it later, or that it's too far off to worry about now. But the truth is, avoiding the conversation doesn't make the issue go away. It only grows, becoming a bigger source of anxiety and potential conflict down the road. And when it comes to financial matters related to our homes, reverse mortgages are often the most misunderstood of all. They're complex financial products, and unfortunately they're surrounded by a cloud of myths and misconceptions. These myths breed fear, and that fear prevents many people from even considering whether a reverse mortgage might be a viable option for them. But dodging the topic, pushing it aside, doesn't actually help anyone. It doesn't alleviate the underlying concerns, and it certainly doesn't provide any clarity or solutions. Over the years, I've learned that facing tough truths head-on, no matter how uncomfortable, is always a better approach than burying our heads in the sand and hoping for the best. So today, we're going to tackle the topic of reverse mortgages directly. We're going to explore how they work, who they're for, and most importantly, what really happens when the homeowner passes away. We'll discuss the responsibilities of the heirs, the options available to them, and the steps they can take to ensure a smooth and stress-free transition. We'll bust the most common and damaging myths surrounding reverse mortgages, lay out all the facts in a clear and easy-to-understand manner, and give you the tools and knowledge you need to make smart, informed decisions about your future and the future of your family. What's the biggest worry that people have when considering a reverse mortgage? It's the fear of losing the family home, the place where they've spent years building memories and raising their families. Or the concern about leaving their children with a mountain of debt that they'll struggle to repay. These are absolutely real and legitimate concerns, and they deserve to be addressed with honesty and transparency. However, these fears are often based on misinformation, on outdated or incomplete understandings of how reverse mortgages actually work. So, grab a cup of coffee or tea, settle in, and let's walk through this complex topic together. Step by step, breaking down each component into manageable pieces. We'll avoid confusing jargon, just the plain, unvarnished facts, presented in a straightforward and accessible way. We'll cover the fundamental basics of reverse mortgages, explaining the core concepts in simple terms. We'll debunk the scariest myths, those persistent misconceptions that often prevent people from even exploring this option, and we'll explain your family's real options, outlining the choices available to your heirs and the steps they can take after you're gone. My primary goal here isn't to sell you anything or to push you in any particular direction. It's simply to arm you with the truth, to empower you with the knowledge you need to make informed decisions that are right for you and your family. So, with all of that said, let's get started and begin unraveling the complexities of reverse mortgages. Before we delve into the specifics of what happens at the end of a reverse mortgage, when the loan becomes due, it's crucial to understand the fundamental nature of this financial tool. So, let's start at the beginning, with the basics. What exactly is a reverse mortgage? What does it entail, and how does it differ from a traditional mortgage? With a regular mortgage, the kind most people are familiar with, you make payments to the bank every month, gradually reducing the loan amount. As you pay down the principal, you simultaneously build equity in your home, increasing your ownership stake. A reverse mortgage, on the other hand, works in the opposite direction. It's usually a home equity conversion mortgage, or HECM, which is insured by the U.S. Department of Housing and Urban Development, HUD. It essentially flips that traditional mortgage model. If you're 62 or older, and meet certain eligibility requirements, you can borrow against the existing equity you've built up in your home over the years. This allows you to tap into a significant asset without having to sell your home. Instead of you paying the bank pays you. This can be in the form of a lump sum payment, providing immediate access to a large amount of cash, regular monthly payments, offering a steady stream of income, or as a line of credit that you can draw upon as needed, providing flexibility and control over your finances. One of the most appealing aspects of a reverse mortgage is that you don't have to make monthly payments to the lender as long as you continue to live in the home as your primary residence. However, it's important to remember that it's not free money. The outstanding loan balance grows over time due to the accumulation of interest and various fees associated with the loan. It's also crucial to understand that you still retain ownership of your home and remain responsible for paying property taxes, maintaining adequate homeowners insurance coverage, and keeping the property in good repair through regular upkeep and maintenance. The reverse mortgage loan becomes due and payable when you sell the home, permanently move out of the home for longer than a year, or unfortunately, pass away. That specific moment in time, when one of those triggering events occurs, is the primary focus of our discussion today, but it's important to clarify that when the loan becomes due, it absolutely does not automatically mean that the bank will immediately evict your family from the home. Instead, it simply signifies that your heirs or your estate are presented with a set of important decisions that need to be carefully considered and made. So, let's explore what those decisions are and what options are available to your heirs when a reverse mortgage becomes due. Let's address a concern we hear all too often, a fear that can weigh heavily on the minds of seniors considering a reverse mortgage. It's time to bust the biggest myth. Signing a reverse mortgage does not mean, and I want to emphasize this point clearly, the bank owns your house. This is a fundamental misunderstanding, and it's crucial to set the record straight. The idea that you're signing away your home to the bank is simply not true. You keep the title and ownership. The most important aspect of homeownership remains firmly in your grasp. Your name stays on the deed. It's a testament to your continued ownership and control over your property. This is a legally binding document that protects your rights as a homeowner. The bank only has a lien, just like with a regular mortgage. Think of it as a security interest, ensuring the loan is repaid. It doesn't transfer ownership in any way. You're still the owner with all the rights that come with it. You can still paint the walls, plant a garden, and enjoy your home as you always have. It's your sanctuary, and that doesn't change with a reverse mortgage. The bank isn't your landlord. They're not dictating how you live or what you can do with your property. They're just your lender. They're providing you with a financial tool, not taking over your home. Their role is purely financial. When the loan comes due after you pass away, which is a natural part of life, the bank doesn't swoop in and seize the house. There's no immediate rush to sell or vacate the property. Your family has time to make informed decisions. They don't want to own homes, that's not their business model. Banks are in the business of lending money, not managing real estate. They want their money back. That's the bottom line. They're looking for repayment of the loan, not ownership of your property. Your family gets to decide how to settle the loan. They have options and they're in control of the process. This is a collaborative effort, not a hostile takeover. The process is legal, orderly, and puts your heirs in control. It's designed to be fair and transparent, ensuring everyone understands their rights and responsibilities. The bank's interest is financial, not personal. They're not emotionally invested in your home, they're simply looking to recoup their investment. Your family isn't at the mercy of the lender. They have rights, options, and the ability to make informed decisions. The home is still yours until the loan is repaid. You retain all the benefits and responsibilities of homeownership during that time. When the time comes, your heirs have options. They can refinance the loan, sell the house, or explore other alternatives, not ultimatums. They're not forced into a corner. They have the power to choose the best path forward. The bank doesn't want your house. They want repayment. That's their primary goal, and they're willing to work with your family to achieve it. Your family is in the driver's seat. They have the power to make informed decisions and navigate the process with confidence. The reverse mortgage is a tool, and like any tool, it's important to understand how it works and what your rights are. Here's another big fear, that your kids will inherit your reverse mortgage debt. But every federally insured reverse mortgage is a non-recourse loan. That means the house is the only asset the lender can use to get repaid. Your heirs are never personally responsible for any shortfall. If the loan balance is more than the home's value, your kids owe nothing extra. The lender can't touch your children's savings, homes, or assets. The debt is tied to the property, not your family. If the home is underwater, the lender takes the loss, covered by FHA insurance. Your heirs can never be forced to pay more than the home is worth. No bills, no lawsuits, no inheritance of debt. The non-recourse feature is a powerful protection. Your kid's financial future is safe. The worst-case scenario? The lender gets the house, not your family's money. The debt ends with the property. Your legacy isn't a burden. So, what really happens when the homeowner passes away? The loan becomes due and the lender notifies your heirs. They're given 6 months, often up to a year with extensions, to decide what to do. No one's getting evicted overnight. The family gets a payoff statement showing the loan balance. They'll also want a current appraisal to know the home's value. With those numbers, your heirs have 3 clear options. Keep the home, sell it, or walk away. They're in control of the process. The lender works with families who communicate and show progress. It's a business transaction, not a crisis. Your family calls the shots. Let's break down those options. First option, your heirs want to keep the house. They can pay off the reverse mortgage, usually by refinancing with a new loan in their own name. If the loan balance is higher than the home's value, they only have to pay 95% of the appraised value. For example, if the home is worth $400,000 but the loan is $450,000, your heirs can keep the house by paying $380,000. The lender and FHA insurance cover the rest. This makes keeping the home realistic, even if the market drops. The process is straightforward: refinance, pay off the reverse mortgage, and the house stays in the family. No overpaying, no hidden traps. If the home means a lot to your family, this option keeps the legacy alive. It's about logic and love, not fear. The rules are designed to protect your heirs. Keeping the home is possible for most families. Sentimental value doesn't have to come at a huge cost. The most common option? Sell the house. Your heirs list the property, find a buyer, and use the sale proceeds to pay off the reverse mortgage. Anything left after the loan is paid off goes straight to your heirs, tax-free. For example, if the home sells for $600,000 and the loan is $300,000, your heirs pocket $300,000. This is real inheritance, not a myth. Many families choose this route because it's simple and often the most profitable. The process is just like any other home sale. The title company pays off the lender at closing. Your heirs get the remaining equity. Reverse mortgages don't eat up all the value. There's often plenty left. It's a practical way to turn home equity into cash for the next generation. Selling is clean, final, and puts money in your family's hands. It's a win-win for many. The third option is the ultimate safety net: walk away. If the home is worth less than the loan, your heirs can simply hand the keys to the lender. They sign a deed in lieu of foreclosure, and the lender takes over. No debt, no damage to credit, no further obligation. This is most common after a market crash or if there's no sentimental attachment. The lender sells the house and absorbs the loss. Your family owes nothing, ever. The non-recourse feature guarantees your heirs aren't stuck with a bill. It's peace of mind built into the system. Walking away is a valid, protected choice. The most important step? Talk to your family. These conversations can be tough, but they prevent confusion and stress later. Problems usually come from lack of communication, not the reverse mortgage itself. If you're considering a reverse mortgage, sit down with your kids and explain your reasons. Share the documents and contact info for the loan servicer. Make sure everyone understands the 3 options: keep, sell, or walk away. When your family knows the plan, there's no panic. Adult children, listen, ask questions, and support your parents' decisions. Don't judge, get the facts. Being informed makes you a partner, not an obstacle. When everyone's on the same page, things go smoothly. Planning ahead isn't morbid, it's responsible. Treat your family's future with care. A little preparation now saves a lot of trouble later. So, what have we learned? The bank doesn't steal your house, your kids don't inherit your debt, and your family has real choices. They can keep the home, sell it, or walk away. No disaster, just options. A reverse mortgage is a tool, not a trap. It can solve cash flow problems in retirement or simply provide flexibility. The key is understanding how it works and making informed decisions. Knowledge turns fear into confidence. You're in control first as the homeowner, then your family. Protections are built in at every step. Don't let myths dictate your future. Have the tough conversations, ask questions, and get the facts. Smart choices come from knowledge, not fear. That's how you protect your legacy and your family's peace of mind.